Hi there, and welcome back to the Money Effect, where I try to keep you updated with all the financial news and lay it in the simplest of terms. So, the big news this week we've had some monetary policy announcements from the Federal Reserve and the Bank of England. So obviously these are the mainstay players. Obviously you have the Bank of Japan, Bank of Canada, but these are the main um, banks that decide monetary policy and affect the world economy. And obviously the big news is, we're reading from the headlines, the Fed to start tapering bond purchases later this month as it begins pulling back on the pandemic aid. Now, what we're going to do is I want to lay this out as simple as possible. So we're going to not get in too much into bond purchases but bond purchase is basically a way that when the Fed wants to improve liquidity in the system, i.e., money into the system, it will um, sell sell bonds that will put money into the system. When it doesn't want to put money into the system, it will start tapering, buying the bonds, taking them out of circulation. So all we need to know is that putting money in is a good thing for the economy. Taking money out, it's not a bad thing, but obviously it doesn't stimulate the economy. So the key announcement is that the Fed has started to start the tapering process, but that's not for a user. What you're more interested in is interest rates, because interest rates is what's going to affect your assets. It's just what's going to affect the money you get in your savings account. I'm sure if you check the any savings account you've got right now, you're probably seeing, unless you've locked the money away from a fixed term, you're probably seeing about 0.5%, and that is because monetary policy set by the Federal Reserve and the Bank of England, which we'll discuss later, is currently at basically 0%, let's just say, or 0.01%. What the banks will do now, the banks will borrow the money off these central banks, and then they will put a little bit on top to give you interest. Obviously, because the banks, their interest rate is zero point 0.1, the banks are not going to give you much more than that, because that's how they're not getting that money. The money is not going back. They're essentially, if they, as a saver, they will give you what they can get from the Federal Reserve, so they're not getting that money. So obviously that's why interest rates are so low. The main concern we have to focus ourselves with is the fact that, and we will go down a little bit more, is interest rates. So now, surprisingly, the markets were anticipating that the Federal Reserve would raise interest rates this month, the last meeting, which was yesterday. Uh, they didn't. They started tapering, reducing some liquidity out of the system, taking some money out of the system, which is, again, it's not stimulating the system. But they didn't actually raise the interest rates. Why didn't they raise the interest rates? Because they believe inflation at this moment is transitionary. And the way they use the word transitionary is, it's temporary. It's something that won't lead to higher inflation, although, you know, we're at, you can see here we're at 30-year highs on inflation. So why are they saying this? We've discussed this before. They believe right now that, supply and demand is imbalances due to the pandemic. You've got a lot of supply chains that have issues. One of the companies, if you look at well, Boohoo, for example, ASOS, these companies, look at their share prices, they've been hit quite hard because of these supply chain issues. Obviously, things have not come back online. It's easy to turn something off. It's like your PC, you can shut it down, but then when you, obviously, times improve, but when you turn it back on, it has to go through numerous checks to get active again. So it's easier to turn off than it is to turn on, and that's what they believe is going on right now with inflation. It's more of a supply issue. Inflation is higher because supply is lower. It's not necessarily because demand is higher. So they don't. They believe once next year or the end of next year, once more of these supply chains come back online, they can get more, more materials that can produce these things. Because obviously, when, a basic example, if you've got a material, you've got a piece of cloth, and you can't get it, then it makes the ones you can get more expensive. So they believe once there's more supply of these things saturating the market, inflation will naturally come down. They don't believe it's a demand problem. Now, that's very important because if it is a demand problem, if it's not a demand problem and you raise interest rates too soon, then that chokes demand, and then we're going to be in a position of, say, what we call stagflation, where we've got high inflation still because of supply issues, but then we've got low demand and low growth and low employment. So the Federal Reserve, they don't want to, they don't want to do anything right now to raise interest rates, and that's twofold. So as an investor or saver, you need to be looking at these central banks and taking cue. Two reasons why. One, obviously, if inflation is not a supply issue and it becomes rampant, then they may make a quick policy change and they might decide to raise interest rates quicker than is expected. And then that will take the markets by surprise and your assets will go down. Yeah, you might get more savings at your bank, but if you've got pensions, if you're a general investor, it's going to take a big knock. One thing I would research Google taper tantrum 2013. That's what happened in 2013. They raised rates too high, and market corrected. Obviously, the past is not always indicative of the future, but it can give you a good idea of what's happening. And obviously, that's why they're being very careful this time not to do that. So, they're going to be looking at the jobs data. They're going to be, they want full employment. They want to make sure that everybody has a job, demand is buzzing, and then they can raise inflation when they need to choke off inflation, but doesn't starve growth, it doesn't starve unemployment. And and right now, inflation is getting out of control, but they're saying it's just due to supply issues. Once that fixes itself, that we will get back to normal. So yeah, just you keep out for it, because if that's not true what they're saying and they're behind the curve, and Federal Reserve people make mistakes and they have to make a rash decision if inflation gets out of control next year, and they make a rash increase when the market's not expecting it. It's very, steep, as in a big jump. Like normally you like to do these things gradually, maybe 10 basis points, maybe zero point 0.1 here, 0.10, 0.2, 0.3. But if you start jumping from 0.5 to 1 to 2, that's when things will get traumatic. So definitely things to look out for. And then across the pond, obviously, the Bank of England, they reported yesterday. So the Federal Reserve was actually Wednesday. Bank of England was yesterday. And, they say hints at future rate rises. So obviously hinting at a future rate rise means they didn't rise it this time. And again, look, you can see here, the Bank of England has kept it at 0.1, 7 to 2. Quite a big change, to be honest. 7 to 2 is a lot of people saying no. And look, you can see here, we've had interest rates. This was after the financial crisis. Because of that, you see where they fell off, and we've literally been in this environment for how many years, and now we're even at a lower environment. Like this was when the financial crisis happened. This is how low we got, 0.5. We're here. So, that says a lot about what's going on. And again, the Bank of England, they haven't started their tapering. They're still putting monies into the economy, and they're keeping interest rates held. And you as a person, when we talk about inflation in simple terms, we're talking about price changes. You go to the shops. Allegedly, wages have gone up. You can tell me, has your wage gone up? Or if you have a wage hasn't gone up, then apparently wages have gone up. There's less workers. People. It's going to be a debate, but they're saying there's less workers. Either people have gone on, just dropped out the labor force. There's certain people that maybe you was near retirement age, you lost your job, and you just thought, you know what, I've got enough money, I'm just gonna retire. I don't really need to go back to the workforce. Habits have changed. People working from home now, thinking, you know what, I'm not doing a job unless I'm working from home. So those jobs that people looked at before, that involve long commutes, people don't want to do them no more. We've had we've got, they don't want to say it, Brexit. Lorry drivers are short. So they're saying wages are going up. So if your wage is not going up, then go look for another job similar to your job. I'm not saying leave your job. I'm just saying compare how much you're getting to how much is out there in the market, and then you can tell me have wages gone up because that's what the government is saying. So you potentially can get a better job. But we do know one thing you can check is energy prices. Energy prices. You know, we've had this whole debate before. Centrica, which I said is probably a stock that's going to benefit. It's been doing very well. Energy prices are going up, food shopping's going up. You can see it for yourself. That's inflation. When things get more, inflation is when things get more expensive. High inflation, things get more expensive. Low inflation, things get more cheaper. In the simplest terms, and we can see this is happening everywhere. The only way to stop that is raising interest rates that will reduce demand and hence bring inflation down. But these central banks don't want to do that because they're saying inflation at the moment is led by supply being too low, which is increasing prices, not demand. And if we do raise interest rates, demand will still have inflation, but then we'll have low demand, low growth, low employment. So yeah, right now everybody's kind of pausing, and it's just a case of you need to keep an eye out because if inflation does jump and these central banks have got it wrong, and everyone don't say because these guys have got PhDs, they're economics, yes, they're very clever people, of course, but they get things wrong, and they're proven, like I said in 2013, you know, the Federal Reserve raised interest rates too quick, and that led to a big sell-off, big slowdown in the economy. So these guys are not, they do make policy mistakes. So right now if 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 you go out, for example, now and you say, I'm going to a nightclub, and you look around that nightclub and you say, okay, have the events prices, for example, ticket prices for a nightclub event are expensive. Now you have to look at that nightclub event and you have to say, why is this ticket expensive? Is it expensive because there's just not that many events no more? Certain promoters because of the pandemic have just not come back online. Certain clubs have maybe gone bankrupt. So there's just not that many events going on. If there's not that many events, if you had 10 events before, but now you've got 3 events, these 3 promoters are going to be like, well, we can charge more because there's limited option for you. Or is it a case that you still have those 10 events, but now, because people have been stuck inside so long, people have been saving, people have been saving money, people have been on furlough. So technically, you know, although there has been increase in employment, people have been on furlough, they have not lost their jobs, they've been chilling, they've been saving money. Some people can go out and spend £100 a week easily. We've had months of lockdown. You think about it, that's £400 a month. We've had about 6, 7 months lockdown. You do the maths, how much people have saved. These people are now like, nope, I'm out. I'm taking that vaccine, I'm taking that COVID passport, whatever, and I'm going to the clubs. So there's still 10 events, but you just got so many more people now coming. And that's what is bringing up the prices now because these promoters are thinking, well, before I used to have 100 people come to my event. Now I've got 200 people. I can't get 200 people in the door. So instead of selling, I can only get 100 people in the door. So instead of saying £10 per ticket for these 100 people, which is £1,000, when I could make £10 per ticket for these 200 people, which is £2,000, I'm gonna charge £20 per ticket for these 100 people, and they're still gonna pay, and they're still gonna come, and that's increasing the price. Now, if that's the case, we're gonna keep seeing this go on, and inflation is gonna go up, and the Federal Reserve is gonna have to raise rates, and that is now gonna have a dramatic effect. So you look around in simple terms. Which one do you think it is? Less events or more people? So if we look at the stocks, bank stocks, obviously they benefit from interest rates rise. If you look at Lloyd's, for example, has gone down 3.7% in the past 5 days. Not a big amount, but you can just tell, this is a bank that when interest rates go up, they're able to pass those rates onto their customers, and then they're able to charge more for loans. They'll get rates from the bank. They'll charge more for it. Customer will pay more for the loans. They get more money. So obviously, that this share price has been increasing over the past month or so in anticipation that we was going to have a rate rise, but it didn't happen and it's gone down. So I still think banks are probably a buy the dip. You could still obviously this is not financial advice. Not telling you what to do, but I still think banks in the long term we're gonna have to raise rates, and as you see here, the Federal Reserve is basically hinting at it, so it's gonna happen. But this is a kind of buy the dip scenario. Same with Barclays again. You've seen steadily rising, holding steadily rising over these last 6 months when inflation's been creeping up, and then yep, last on Thursday, literally big drop because no rates were risen. So again, could be another buy the dip scenario. And then, we've got a lot of stocks in America, those kind of growth stocks, the skills, the Pelotons, Peloton's got another issue, but this is a stock that's, come out from the corona and these low interest rates. Obviously it's a lockdown stock as well, so that helped, but coupled together will led to such a great price rise. And then as you've seen, taper talk's going down. Obviously people are going out more as well. So different factors. But yeah, at the moment, everybody's it's kind of a wait and see approach. And as I said, for yourself, for your savings, for your investments, for your pensions, interest rates, you need to know what's going on with interest rates. For your mortgage, for those who've got a mortgage, interest rates go up, you're paying maybe £50, £100 more. If you're already on a tight budget with energy prices still high, it's taking money out and they're saying wages are going up, but your wage ain't going up. That's gonna take a lot out of you. So you have to think, you have to pay attention to this stuff and decide between yourself. Is it because more people just didn't lose their jobs and got more money and spending more, hence we're getting inflation, or is it because supply is just reduced? You decide, but it's definitely at the moment we're on pause. One day these rates are going to go up. If they go up at the wrong time, we're going to see a correction. If they go up at the right time and the Fed was right that this is just a supply issue, inflation will naturally come down as more supply comes onto the market. And when the Fed does raise the rates, it's just gradual. Then we're not going to see nothing, and we'll see maybe a slight dip, but it's great bull running. Assets will increase, growth will increase, people will have a lot more money, and you'll actually get some value for your savings. So yeah, that's it for now. So big topic for the week, and yeah, if you like the video, please just like and subscribe, and yeah, try and bring you the content easily explained than all these other economists and finance YouTubers. And we won't touch on crypto because that's the big topic. Um, I haven't heard the argument that high crypto is a store of value, Bitcoin. So high inflation, go buy Bitcoin. Um, Whether that's true or not is up to you. That has been a narrative around Bitcoin. So again, you do your own research. Interest rates go up, then surely that means Bitcoin is going to go down, right? So again, if you were in that cryptocurrency space, it's something to pay attention to. But anyway, like, subscribe, and enjoy. Yeah, the money effect.